Hello, I am Stacy again with RE Titans LLC. Thank you for joining me on this tutorial of RE Titans REI Deal Analyzer Plus. Today I am going to demonstrate how you can quickly analyze a real estate deal you are evaluating plus produce professional looking documents to share with potential partners, lenders, or private investors. It will also help you as an investor to make decisions about how you structure your deal to maximize your return. Let me start by covering the fine print. This is meant to be an educational tool. RE Titans LLC, including its owners, officers, and employees, better known as RE Titans, disclaim any and all representations or warranties in regards to your use of this product. There are inherent risks in being a real estate investor. You should always validate the accuracy of the information presented within this program as well as do your own due diligence before investing your money in real estate. In addition, RE Titans does not and will not provide services reserved for certified public accountants or those licensed to practice accountancy, perform any services constituting the practice of law, or provide licensed real estate services. RE Titans may offer opinions and/or advice from time to time based upon past professional experience, but RE Titans at all times clearly advises you to seek an opinion of such certified individuals or firms as you, in your sole discretion, deem appropriate. The proceeding specifically includes, but is not limited to, any statements made during the course of this video. Now back to the tutorial. This video is a first in a series starting with our current product, which allows you to evaluate retail flips. We define a retail flip as a short-term investment whereby you purchase a property at below market value, then rehab the property up to the point necessary to obtain the maximum market value, or ARV, after repair value. Future versions of the product will include similar analyses for rental properties, owner finance, as well as options for financing either flips or rentals using subject to financing. Today, though, we're going to focus on analyzing a retail flip property. First, I want to show you some screenshots of what we get after we enter our data into the program to analyze a possible retail flip. The first page is the data input screen. You will note that all the fields appear to have data entered into them, although that is not necessary in order for the system to provide you with an evaluation of a retail flip deal. Once we get started, we will only be entering the data necessary to evaluate our retail flip. But in the event you want to compare additional options, you will be able to enter all relevant data into the system to compare. Second is the analysis of the deal using an all-cash transaction. We will be going over the different components of the analysis once we get into the live version. You will note this includes summary data for a quick at-a-glance analysis along with details of how the costs are derived for the analysis. Next is an analysis similar to the one for a cash transaction, but this analysis uses hard money or HML to finance your deal. You will also note in the lower right-hand side of the page on both there is a breakdown of the cash out and net profits by categories for investor, which is you, and partners as appropriate. This allows you to look at the impact of doing a deal on your own versus bringing in others to participate in your deal. Very valuable information if you're putting together a team to do your investing. Last is the summary page. This basically takes all the information from the preceding two analyses and summarizes it side by side. What you don't see in this screenshot, but I will show you later in the video, is how you can make quick changes to your assumptions without going back to the original Data Input tab to see the impact of those changes to your deal. Now that you have an idea of what we will get in the end, let's go back to the beginning. I will start by opening a blank version of the spreadsheet. You want to remember to save a master copy of the program with all the data input fields blank, then save and rename individual property evaluations as separate spreadsheets. It will save you a lot of time having to clear out the data input fields, plus ensure you are not corrupting your future analyses with old data. We save our individual property analysis by the street address to quickly retrieve them when needed. Let's begin with the basics. First, you'll want to enter your company name or the name in which you are purchasing the property. Talk to your attorney, tax advisor, or CPA, but we recommend doing your business in an LLC. For our purposes today, I'm going to call our company ABC Investment Properties, LLC. Next is the street address and legal description. So in these fields, I'm going to enter 4321 any street, city, state, the zip code, followed by the legal description of Lot 1, Block 11, Section 2 of New Horizon Estates. Now let's enter the rest of the property basics: square footage, beds, baths, etc. You will note there are two fields for entering the square footage: heated square footage and appraisal district. This is an issue we see investors sometimes get tripped up on when working in certain areas, especially with homes under the jurisdiction of city municipalities. You want to make certain the square footage you are buying is the same the appraiser is going to use when valuing your property. The last thing you want to hear is you bought a property based on 1 square footage only to have it appraised for less. Check with your local realtor or other real estate professional for more advice on that subject. Next, we'll enter the after repair value for a retail flip. Since this tutorial is not going to cover after repair value or a rental property, we will leave that field blank. Our next step is to enter the purchase information for acquiring the property. Here we have our purchase price of $90,000, so I'm going to enter that into the purchase price field. We actually got this from a wholesaler, and we're paying them a wholesale assignment fee of $5,000. We'll go ahead and put in some seller concessions here. We're going to give the seller $500 to help them move out. Our closing costs are estimated at 1.5%. We think we're going to have some additional closing cost of $125. Have our hazard insurance estimate of 1.3%. In our example, we are going to be paying the title policy, so I'm going to click no here. We have a title policy base rate of $8.75 and a title policy premium of $5.54 per thousand. You will note that both under closing costs and hazard insurance, they are based on percentages. I am using values we have found to be reasonable in our market, but you will want to have this information available to you when you enter your own data. Also, it is common for investors to pay the title policy when buying distressed properties. Therefore, as you noted, I left the field in there marked yes. But if you're not paying the title policy, you can change that field to no in and leave the base rate and premium blank. Since we are paying the title policy in our example, I am using some rates I have on file. You can get this information for yourself by contacting your local title company or doing a search for title policy rates for the state in which you are investing. The next section in our data input form is where we will enter the rehab estimate and loan information if you're considering a hard money loan. I'm going to pull my rehab estimate from a separate spreadsheet we use in our business to estimate the cost of repairs. After our on-site inspection of the property, we work up a budget estimate to determine what we believe will be the total cost in order to repair the property to a market value based on area comps or comparable sales. You will note there's a column for contingencies. This is where we would normally put unknowns or potential risk in repairing a property, but don't want to include in our base budget. This is especially important when rehabbing older properties where you really don't know what you might find once you get started. Whichever number you use in your decision is based on how you want to evaluate the deal. We like to be conservative and start with the worst case scenario. What we do not want to do is buy a property based on base case and end up losing money. So we'll go down here, we've worked up our budget. You'll notice that we have all the different categories. In this case, we've determined that our rehab estimate for the property should be $41,685. Back to the analyzer, I'm going to enter the amount of our rehab in the rehab estimate field. Next, I'll enter our rehab construction time estimated in months. For our example, we're estimating it will take us 90 days or 3 months to complete the rehab. I'm now going to enter our loan information: loan to value, loan origination points, interest rate, repairs to escrow, and any other escrows. The data for our example are based on standard terms provided by our partner, Jet Lending LLC, who finance many of the deals we do here in Houston, but you will want to use the information provided by your lender for your evaluation. Here we're going to use a loan to value of 70%, loan origination points of 4 or 4%, a loan interest rate of 13.99%. They're going to escrow 100% of the repairs, and also, just for conservative estimates, escrow an additional $2,500. You will note in the next section, if we were evaluating this property as a rehab rental, we could also enter the same kind of information down here below to do our evaluation. But in this case, we're going to stick with a retail flip. Moving on to the middle section of our data input tab, I'm going to enter our target ARV for a retail flip. The industry standard is 70%, so I will enter that in this field. We will use the target ARV for rentals in the subsequent video. Then there are my comp data on comparable sales, followed by monthly holding cost. You want to make sure you really know your holding costs because they are a critical component of evaluating a deal, and real cash you will be out of pocket while you rehab the property. We will leave the fields for subject to data blank at this time, as is not relevant to our evaluation. So based on our market comps that we got from our realtor, we know that the high-end price per square foot in the area that we are doing this flip is $80, so I'll enter that in the high end. And we've been told the low-end retail for a retail flip, that's a property that has been repaired, is $71.11, so I'll enter that into that field. Next, I want to enter our estimated monthly holding cost. We've estimated it's going to cost us $75 a month for utilities. Maintenance is going to be $25. Our taxes are estimated at $395 per month. We have HOA fees of $30.50 per month. And we get a flood insurance policy, and that's going to be $42 per month. So now we have entered all the data in there for estimating our monthly holding cost. Now we're going to move on to the last section for this example, which is to focus on selling the property and how we will pay for the deal when we sell it. We don't expect to buy pay any buyer concessions in our example, but there's a field there if that's relevant to your deal. So I'm going to put a 0 there. Next is realtor commission. Traditionally this is 6%, but in our business we use a flat fee listing service and pay a selling agent fee of 3%. So I'll put 3% in that field. Our flat fee listing service, I'm going to put on $375 for that. The next two fields are really important to the evaluation of your deal. How many days it will take to market your property and how many days it will take to close after you receive a contract from a buyer on your property. Our analyzer uses this information to calculate a net profit on your deal, as holding cost, as we mentioned earlier, is real cash out until you transfer ownership to your buyer. You can leave the fields blank, but I highly recommend entering the data if you have it. For our subject property in this example, our average days on market are 32, so I'll enter that in that field. And our mortgage clear to close days, which is the date from the time you receive your contract until you close it and receive funding at the title company, is 45. Last is your estimated closing costs, title policy, and fees like we entered when buying the property. Again, you can choose yes or no for title policy and enter the data as I am in our example. So in this case, I'm going to enter 2% for our closing cost on selling the deal, $125 for additional closing cost. I'm going to leave title policy as yes again. If I enter it no, it won't calculate that amount, so I'm going to use the Y for yes. Our title policy base rate of $875 and our policy premium of $5.54 per $1,000 on the sales price. Again, you notice there are additional sections here for monthly rental if we were going to do this as a rental rehab and put it on the market for someone to rent it back from us, or an owner finance if we were going to offer it as an owner finance deal as well. But you'll note that for the purposes of our evaluation of a retail flip, we don't have to enter all the information, just what is relevant to the type of deal that we are wanting to evaluate. Scrolling down, we're almost finished. The final section is partnership splits. If you're doing a deal on your own, then you can enter 100% in the investor field under investor. Actually, I want 100, not 1,000. And the same thing for profit, 100%. If not, though, you'll want to enter the percentage that you as the investor are contributing to the deal, followed by the relevant amounts for each of the other participants. You will note that partner field 3 field is a default that calculates a reconciling percentage based on the amounts you enter in other fields. Do the same thing for how profit is going to be divided among you as the investor and the partners. There are numerous ways to structure a deal, so I'm not going to go into those in detail. But I think you see the options are endless as how you can present the opportunity if you're going to use partners to help you in your real estate business. I'm going to enter the amounts we have chosen to use in our example into those fields. You will note that the profit split is not equal to the investments. This is because in our example, the investor is bringing the deal to the other partners, plus going to be active in the rehab and disposal of the property. Therefore, we are going to get a higher percentage of the profit in order to compensate us for our time and efforts. So in our example, we as the investor are going to put in 10% of the cash in order to do the deal. So as I've entered here, 10%. We're going to have one partner in this deal and they're going to put the other 90% of the cash. But in our profit split, we're going to get 30% of the profits and the investor is going to get 70% of the profits. Now you note again down here in partner 3, it's always going to default down here to partner 3 to whatever's left over. So if you put in a number less than that, say 60, partner 3 would show 10%. But in our case, we only have one partner and we're going to put in 70. In the same way, though, you will note if we were put in a higher percent, 80, it's going to put negative 10%. And we'll show there that we need to go back and put another number to be accurate. So I'm going to put the 70% back in there. Okay, now that we have entered all our data, let's see how our deal looks. First, we'll take a look as if we were going to do the deal completely with cash. Therefore, I'm going to go down here to the tab that says Flip Cash. You will notice there's a big blank space up here in the upper right-hand corner of the page. This is where you can put a nice picture of the property to show your lenders, partners, etc. I'm going to grab a pic and paste it on the page. You also see there's a note as to the size you need to fit the page, so I'll resize the pic and center it. Okay, so I'm going to go grab my picture. Drag it over here so we can see it. Notice it's way too large. If I change the width to 4.5, makes it a little bit better. Get it over here and put it right there. Looks pretty nice there, doesn't it? Now on to our analysis. You note over here we've got our information for our data input page. We got our ARV, or after repair value, of what we expect to sell it at, our heated square footage, our price per square foot, beds, baths, garage, half baths, there's no pool, and the year built. If we scroll down here a little bit more, you'll note again our cash purchase price, our wholesaler fee, seller concessions, title policy, closing cost, hazard insurance. That gives us our gross purchase price. That's the money that we'll have to take to the title company when we go to close on this deal. We now have our rehab estimate, which we got from our prior budget. Note there's no loan to value information, loan amount, or monthly interest payment because this is a cash-only transaction. Next, we have our total project time in days, which back from our data input sheet, we have that it was going to take us 90 days to rehab the project. Our days on market or marketing time is going to be 32 days. It'll take 45 days after that for our buyer to close the deal. I understand that probably seems like a long time, but here recently, as a factor of Dodd-Frank in something called TRID, you can Google that, T-R-I-D. We've noted that the buyer time to close is a lot longer than it used to be, so we want to make sure and have that estimated in our analysis. We then have converted our project time to months, so we're saying it's going to take us 5.57 months to do the project from start to completion and disposition. We have our monthly holding cost. You notice again from our data input sheet we kind of have a breakdown of what those costs are. We've got our utilities at 75, our maintenance, taxes, HOA fees, flood insurance, and total. Now some of these things like your taxes and HOA fees, they're going to show up probably on your title closing and you're not going to be paying those out of pocket. But that can come into effect if you're holding a property over the end of the year. You will have to pay those taxes most likely if you go past December 31st or January 31st, the same thing on your HOA fees. So you want to have an understanding and handle on that when you go to do the deal, because that can definitely be cash out of pocket. Certainly your utilities and your flood insurance and your maintenance are going to be out of pocket. Scroll a little bit down, further down here, and we have our holding costs multiplied by our total project time. So we're estimating our total holding cost during the course of this project is going to be $3,198. Then we get down here on the closing costs when we sell it to the end user owner occupant. So we have our realtor fees, which were calculated on our 3% and our flat fee listing, our estimated title policy, and the remainder of our closing cost, giving us a total closing cost at time of sale of $12,205. Next, back up here to the project recap. So we have total project cost of $143,534. You notice that we have a net project cost of less than that at $136,685. Well, what's the difference between the two? The total project cost is your gross purchase price plus your rehab plus your holding cost, but does not include closing cost at sale. Your net project cost is going to be your cash purchase price plus your wholesale fee plus your rehab. That doesn't include any of your holding cost, your closing cost, or anything like that. Why do we have that? Well, we want to look at that ARV percentage. Remember we put 70% in there? We want to look at what is the project cost as compared to our target ARV. So if that number was higher than 70%, we might want to relook at the deal, relook at our rehab estimate, our purchase price, or whatever it is, but we know that we don't want the net project cost to be more than 70% in our evaluation. We actually want it to be lower, and the lower it is, the better it is for us. Same thing for gross profit. Gross profit's basically going to be the difference between those two numbers in our ARV, which easily is calculated at 30%. But then here's what's really important. What's our net profit? Our net profit is going to be our sales price or ARV less all cost, including closing cost at time of sale. That's really what is the net cash we're going to put back in our pocket after all things are said and done, and we've disposed of the property and we go on to our next deal. Another really important number. What's our cash at closing? Basically, how much money are we going to have to bring to the title company when we go to close on this deal? In our example here, it's $98,651. You'll notice that's the same number as we have in our detail over here, and that's how much money that it takes to close the deal. And since this is a cash transaction, that's how much money we will bring to the title company. The last is our total cash out of pocket. You'll note again that in our cash deal, it's the exact same number as our project cost, because until we close the deal, we're paying for this all out of our own pocket, and therefore that's how much cash we should estimate, I would say at minimum, in order for us to do this deal. We need to have access to that amount of cash. Estimated reserves is something we'll get into under the hard money loan, but that's something that's not relevant in this because we don't need any reserves. We need all of this to be cash out of pocket. Our last section, and probably the most important, and the one that we're most interested in, is a breakdown of what it's going to take to do the deal and how much money we're going to make. So this here we have our investor partner breakdown. You notice, if you recall, that we have investor, which is ourselves, and partner one. We didn't have any second or third partner in this. And out of that total $143,534, we've agreed that we'll bring 10% of that amount. So therefore, we're going to need to have $14,353 to do this deal. And our partner is going to bring 90% of the cash, or $129,180. So this is how it's going to break down as far as who's going to bring what money to the table. How that would be done would obviously be up to whatever agreement you have with your partner, but at some point, assuming that our estimates on our time frame, our rehab, and all the other factors are correct, we're going to both have to bring this money to the deal. Next, though, we have our net profit. So remember up here we had our net profit of $39,261. Well, how is that going to be broken down and distributed once all costs are paid? Well, in our scenario here, we're getting 30% of that net profit to help us compensate us for our cash that we entered plus our time that was spent. And our partner is going to get 70% of the profit, so $27,483. Over here you'll see that we have ROI. ROI is our return on investment. What are we getting back for what we put into the deal? I'm going to start down here at the partner first because that's more relevant. The partner is putting in cash. We're assuming the partner is going to be passive and that they're really looking at this as an investment without any active participation. So based on our cash deal, if you take, it's pretty simple, $27,000 based on $129,180 that they put into the deal, they're getting a 21% return. Now you'll notice up here that for us as the investor, we're getting a pretty high return here, 82%. We want to show this to you so you'll see what your cash, $11,778, or profit, $11,778 divided by the cash, $14,353 looks like. But you really need to think about this evaluation because this 82% is your cash return, but you also need to factor in, what was your time worth. The next is your annualized ROI. And the way we calculate that is we take the actual ROI, which is the 82 or the 21%. We divide it by the project time frame in months. That's the period that your money was outstanding as you did the project, and multiply that times 12 or 12 months. So what this says is that if you did this deal multiple times during the course of the year based on the project time, what would your annualized return be if you were taking that cash and getting this return, in this case, every 5.57 months? Well, if you had that cash and you were getting this return every 5.57 months, your partner would be getting an annualized return of 46%, and in your case, you would be getting an annualized return of 177%. Now we have to take this in perspective. This means that you would be finding these deals, putting these deals under contract, and doing them at 5.57 months each time. We know in the real world that that's not realistic, but you still want to look at your annualized ROI and see what is it that you are making if you're doing this kind of deal, if you compared to other options you have to invest your money in other alternatives. All right, now that we have an understanding of how this works if we use all cash, let's take a look at it from a hard money loan standpoint in the next tab. You will note the structure of the analysis is pretty similar to the cash example with a few exceptions. But first, let's go ahead and put our picture in here. Go ahead and center it kind of like we had a while ago. So we have a nice looking sheet that we can use later to present to our investors or partners or lenders that we're going to want to show this information and why we're going to want to do this deal. So you'll see we have some of the same similar information. We have our ARV, our square footage, our details of the property, price per square foot. That's not going to change. You will start noting though that some of the other things in here do change in the sections we have. So our cash purchase price, that hasn't changed. Our wholesale assignment fee, concessions, closing cost. You'll notice now though that we do have a loan origination fee. That's because we're doing a hard money loan and that would be paid at closing. So you'll note here that our gross purchase price, if you recall from the prior example, was more in the neighborhood of the $90,000, is now $104,000. Our rehab estimate stays the same. Those fields we had blank earlier are now filled in. Our loan to value is 70%, our loan amount, which is going to be 70% of our ARV, and a monthly interest payment. Our project time frame hasn't changed, project time frame in months, but you will note here that our monthly holding costs, which were $575 in the cash example, are now $2,166. And here's the breakdown of that. Same cost in your utilities, maintenance, and other fees, but now you have your interest that you will be paying monthly on your deal. So that gives you $2,165.86, or rounded up to $2,166. You'll note down here though that our closing costs, those haven't changed, still $12,205. Now up to the details. So here, our net project cost is still 70%, but our total project cost has gone up, and that's obvious because we're doing this with a hard money lender. Therefore, we're going to have points, interest, and fees when we do that. Note that our gross profit's the same, but our net profit has changed as well based on the cost that it takes us to fund this deal using a loan. Now, two very important parts, and we'll look at this in more detail in the summary page, our cash at closing. If you recall previously, our cash at closing was this number over here, which was our cash purchase price, was the same number as our cash at closing. But since we're doing a hard money loan, we only have to bring a certain amount of money to the closing table. In this case, it's estimated to be $9,296. You also note another big difference here, our cash out of pocket. Previously, our cash out of pocket was going to be our total project cost, but since we were doing a loan in this case, our cash out of pocket is going to be a lot less than that. Finally, we have estimated reserves. Reserves are the money that your lender is going to require you to have in order to do the deal so you can finance repairs before you're getting draws on your repairs. The details that is a much longer tutorial, but basically in our scenario, our partner Jet Lending, who's provided this information, has told us that you need to have about 1/3 of your repairs, and then we showed some additional escrows, if you recall, on our data input page over here at $2,500 is going to be needed in reserves, and that's the money it's going to take for you to do this deal. So here, now down to the investor partner breakdown. We've got the same scenario here. You as the investor are bringing 10% of the cash. In this case, the cash out of pocket, which is $2,135, and your partner is bringing 90% of the cash, or $19,217. In the same scenario here, we've got a division of the net profit. You're getting 30% of the net profit, $7,483, and your partner is getting 70% of the net profit, or $17,460. Now, what you'll look at here is where you get a considerable impact is your return on investment. So if you put in $2,135 and you get back $7,483, your actual return on investment is 350%. And then, if you recall again, we'll annualize that based on our 5.57 months. That's a 755% return. Quite a considerable return there if you compare it to the stock market or other options. The same way, we'll look at your partner. Your partner's putting in $19,217. They're getting back $17,460, which is a 91% return, or an annualized return of 196%. I didn't go over it before, but we'll jump down here to this next section. This is for you to put in your market comparison, and these fields are left open. We didn't have enough room on our data input field, but you can put in your average high and low comps on your square footage, your sales price, and your days on market. Now, this days on market here is for our subject, which is estimated our marketing time. But this is some additional information you put on here. Something that we didn't get into, but we'll get into the comparative, is your profit analysis in the event that your profit takes more time than you have up here in your estimate of 167 days. So what we've done here is we've taken your holding cost, and if it takes you an additional 30 days, what would be your profit? 60 days, 90 days, 120 days, 150, 180. So what we're looking at here is that if your project ends up taking longer than what you expected, what is the impact on your profit? As you notice here, it goes down, and it goes down by your monthly holding cost. That's something that you'll have to evaluate. Now, what isn't taken into account here, especially when you're looking at this from a hard money loan perspective, is any renewals or other costs you might run into if your project time frame goes beyond the term that you have on your loan. That's something you want to make sure and check with your hard money lender, and make sure you understand that and incorporate that into your cost estimate. You'll also note that under the cash, we have the same analysis where you have your profit, your original profit, and then your monthly holding cost, and then how that goes down as well as you extend the project beyond your original estimate of 167 days. Finally, we're going to go to the deal summary comparative. We have all of our numbers from the preceding two pages side by side to evaluate the deal using cash or hard money. We start with the basics, comparing the project cost and breakdown of how we get to those amounts. You'll note here we have our ARV, our purchase price, which is our cash purchase price, including all of our closing cost, our rehab estimate, our holding cost, our closing cost, and our gross project cost. You'll notice the differences here, 143 versus 157, 155 versus 170. Next, we get into our net profit. Our net profit is $39,261, or 20%, based on doing this as a cash deal. $24,943, or 13%, if we do this as a hard money deal. And then we have our ROIs, net and annualized. Now, this is the ROI on the total project. This doesn't include our investor breakdown, which we'll get to later, but this is just showing you on a project to project basis, what is your ROI for the investment net and what is it annualized? This is followed by our net profit with our holding time reduction that we were just looking at. So therefore, if we scroll down the screen here, if we hold the property additional 1 month, what does our net profit look like, both on a dollar and percentage basis, 2 months, 3, 4, 5, and 6 months? How does that impact us? We really want to know that if we go beyond our project time frame, what is our net profit going to look like? And is this a deal that we're willing to go forward with, considering all the risk? This next section, which I think is very important to the deal, is our cash requirements. Now again, this isn't broken down by the investor or the partners. This is just in total. But if you look, what is our cash requirements on closing on the purchase? In this case, it's $98,651 versus $9,296. What is our total out of pocket? This is the estimated total money that we have to spend in order to do this deal. In the cash example, or the cash option, it's $143,534. As you note here, it's 100% of the project cost. We would have to fund 100% of the project cost in order to do this. One thing to note that is not shown on here is that if you have extended holding time, this number, in both cases, it's going to go up by your monthly holding cost and any other fees that come in to affect that. But going over here under your hard money side, your total out-of-pocket based on the project time frame would be $21,352. And then again, if you're doing a hard money loan, you're going to have estimated reserves of $37,747. Now again, the difference between these two numbers is reserve is money that you have to have available to cover your out-of-pocket, plus money that you have to put out on the project as you're doing it to pay your contractors or other vendors until you're reimbursed by your hard money lender. Now we get down to the breakdown of the cash investment by partner. Again, taking this total numbers and breaking it down by the partner and the investor. So in the cash investment, we have a recap again. You're talking about $14,000 in cash versus $2,135 if you go with a hard money loan. Your partner would bring $129,180 into the deal versus $19,217. Then we get into our cash return, profit split, $11,000 versus $7,400, $27,000 versus $17,000. And then we get down here on a recap of the ROI again. So we have 82% with annualized 177%, or 21% versus 46%. And then we have 350, 755, 91, and 196. Now one thing that we have done here is that if you want to hide your own ROI and just show your partners, you can go in here and you can delete this and just show your ROI for your partners, because again, when you're evaluating the investor, you have time invested in this that kind of skews your ROI, at least in our opinion, when you're doing these kind of deals. And so you might want to take that out and just show your partners what their ROI would be in the event that they participated. Now let's go back up to the top of the page and look at a feature that we haven't covered yet. This would be the modifier fields to the right of the main page. These modifiers allow you to quickly change a few key parameters of the deal to see how it impacts the evaluation. You will see in the comment here that the changes you make will affect the summary page and the detail page, but it does not change the main data input page. It is not a big problem, but just an aspect of the program you want to understand if you start using it. The main reason for having the modifiers is to save you time when trying to see how best to structure your deal and how different factors might change the evaluation of the deal and how that impacts it in the end. I'll now demonstrate that just for example purposes. So if we estimated maybe we can get a little bit higher ARV, and 195 was a little low and conservative, I can add $10,000 here. You'll note that changes the ARV to 2005. It impacts all of our numbers here, our project cost. Our net profit, as you notice, our net profit has gone up. 34,208 versus 49,261. And this all the way down affects our analysis. Goes up from 11,000 to 14,000 here and 7,000 to 10,000 here. What's very important is if you do this and you decide that you leave one of these modifiers in, when you go back here to your flip deal, it's going to change all the numbers accordingly. Profit, everything in between, your loan amount. Same thing for your cash deal. 2005 has changed our net profit and all of our other different numbers that we have in here. So it does change these, which are considered your printable show pages when you do this. We can do the same thing to the purchase price. We can say maybe we think that we can buy this property for 5,000 less, or we're going to go in. If we can't buy it for 5,000 less, we're not going to do the deal. So we could put it in here though, 5,000. And sorry, I need to put negative 5,000, not 500. So it drops our purchase price. The same thing in here, it drops our purchase price here, which changes our total gross purchase price after closing cost. Same thing here, 85,000 versus our original 90,000. Again, like I said though, in the data input, it doesn't change it here. It only changes it on your analysis sheets and your summary sheet. We can say the same for our rehab. We could estimate a lower rehab, a higher rehab, so we could, add 7,500 here, and it'll change it, and you notice all your numbers in here flip and change and calculate. Or we could say we're going to do it for less than 7,500. So there's a lot you can do with that. Same thing with closing cost. Normally the numbers you're going to impact the most is going to be your ARV, your purchase price, and your rehab. But again, like I said, we were using a 3% realtor commission. If we want to go in here and change it and say, you know what, we're going to have to look at this using a 6% realtor commission, or we want to look at what's the impact if we have to go that route. Rather than going back to our data input sheet, we could take our ARV of 205,000 times 0.03 and add that, and then everything obviously drops down from there. So just something that's pretty neat that you can use whenever you're doing this. And we will clear those back out for our evaluation here. Last, we'll look at our output. So what does this look like and what do you get when you're done? So we'll start here with our summary page, and we'll do a print screen. You'll notice we'll get a print screen of our whole evaluation, very nice, professional looking, that we can print out and use. As I showed you down here, we'll see the investor still in here, but if we decide to eliminate the investor, we can do that as well. Next, we'll go back over to one of our other pages here. So we'll go to our flip hard money loan page. Same thing, we'll do a print screen. And this is what you get, a very professional looking, very easy to read document that you can print out. You can save it to a PDF. You can print it in whatever form you want. And then you can obviously share this. This would be something, especially with your lender, to show that you could send them and show them why you think this is a good deal and why they should fund it for you. But it has all the relevant information that your lender is going to want in here in order to do the deal. Last, we have our cash flip. Note in here the same thing. Very professional, that you can show to your investors or others, and to show them why they should do the deal, what kind of return they're going to get, and what you've done, that you've really done your due diligence and taken your time to put together a professional looking document for them to consider investing money in your deal.